Where should you buy your next investment property? How should you choose the location where you're going to put your money? And what are the floods going to mean for Brisbane property values? These are the two questions we answer today, your questions that we answer in today's question and answer session with Brett Warren. At the end, you're going to learn a little bit about how we put our strategic planning together to help choose locations, and Brett's going to have a look at what history teaches us, including a university study on what the 2011 floods did to Brisbane property values. So, welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
I love these regular question and answer shows because clearly if these matters are on one person's mind, they're probably on the mind of other listeners to this podcast as well. So today I'm joined by my business partner and National Director of Metropole, Brett Warren, to answer some of your questions. Hi, Brett.
Hi, Michael. Good to be with you. And yeah, we've got a number of questions that have been left on either the property update. We get a couple on Facebook and the website. And I do think it'll be of interest to a wide range of listeners. So let's get underway, Michael. And the first question is from Russell B. Thanks for the great podcast, Michael. I really love it. Can I please ask a hypothetical question? If an investor had to spare $1 million, where and how should they spend it? In the bigger capital city markets where the median prices are now close to $1 million, or further out, in the regions maybe where they get a bit better bang for buck, where would their money be better spent? And are there any areas that should be avoided at all costs?
Well, Brett, I bet as a property strategist, that's the most common question you're asked as well. It may not be $1 million, but I got 700, I got 500, whatever. Where should I go?
Absolutely. Yep.
Sure. Well, good question. Where should you invest? Now, everybody wants to know the best location or Australia's best growth suburbs. But Brett, you and I have worked together long enough and we know that's the wrong question. It's a shallow question, even though that's where most property investors start their journey. They try and choose a top location because they think it's the best place to invest and then find a property that's going to make a great investment. However, when you look at the results of most investors, you see what they achieve. We know that it makes little sense to do things the way everyone else does because they don't get the results they expect in the long term. They never get past their first or second property. And I guess it also makes little sense to ask the same question they're asking. So first of all, Russell, thank you for leaving the question. And please don't be offended if I don't answer it in the way you expect me to. But if you're wanting to outperform the average investor, Russell, or whoever's listening to this, you and me at the moment, Brett, if you want to develop financial freedom through property, don't start by selecting a location or even looking for that ideal property. You see, in my mind, property investment is a process. It's not an event. And things have got to be done in the right order. And selecting the property comes right at the end of the process. Selecting a location comes at the end. Of course, the property you eventually buy, it's going to end up being the result of a sequence of questions you're going to ask, answers you're going to have to find, decisions you're going to have to make before you even start looking for a location. So I know long before we talk about property in the right locations at Metropole, Brett, we ask a whole lot of other questions, don't we?
Well, we certainly do. And I guess at the end of the day, Michael, we always start with the end in mind. I know most people do start about a location or a property, but I think they're going about it the wrong way. So what we like to do is start with the end in mind and help them understand, where they're going to. If you don't know where you're going, you're probably not going to get there. So once we understand where they're going to, we can actually reverse engineer the process, come back to where we are now, look at their existing portfolio, their existing cash buffers and their finance setup, all those types of situations. Perhaps they're looking to buy a new home or downgrade. Perhaps they're looking to undertake another investment or a home as well. So there's all those different scenarios we've got to understand. And then we can develop a plan and a strategy to actually help them hit those targets and hit those goals. And as you said before, Michael, that's not what the average investor does. The average investor starts with a property or the property, and then fingers crossed, they hope it all magically works out in the end. But we've got to target long-term wealth-generating incomes and assets, and that's very, very different to just investing in property, isn't it?
Oh, very much so. So what makes a good investment for me at a different level of my investing career is clearly very different to what happens to another person. It suits different people at different stages, different risk profiles, different sizes of the portfolio. So really, as you say, long before you start, we really have to have a look at what their long-term goal is. And I know at Metropole, we want our clients, as you said, to develop that income stream for retirement for their future years. And we're actually not trying to outperform the averages in the short term. What we're actually trying to do is create a substantial asset base for them in the long term, which may mean we're not going to, well, it's not may mean, it does mean we're not going to chase that hotspot or the next fancy growth area, Brett.
No, there's lots of trends and fads all around the place at the moment. I mean, everyone's an expert at the moment, given the last 12 or 18 months, but it's important to have that framework, isn't it?
Sure. So I guess my first recommendation to Russell or anyone else listening is when asking where to invest, get an independent property strategist to help you formulate a plan. Now, I know, Brett, some people are going to think, yeah, there they go again, it's self-serving. But in my mind, it's just too difficult to do on your own. And I found that most investors, they tend to be too emotionally involved. They can't do it on their own. So, Brett, maybe just quickly, what are, in your mind, since you're involved in putting all of these plans together, what are the benefits of putting a plan together?
Yeah, look, I mean, I guess the first thing is it's critical to actually understand where you're heading and where you're going and what you're aiming towards. You know, people accumulate all these assets and they think they hope it all works out, but obviously, you know, most of the time it doesn't. So, you know, really defining your goals, then working out if your goals are realistic. You know, especially given your time frame. I know people who have very substantial goals in a 5-year period and others who have more modest goals in a 20-year period. So, really defining that. And then you'll find out, you know, what you've done well and what you've done wrong. I think it's also an opportunity, if you do have a couple of assets, to take a step sideways, analyze those assets, make sure they're the assets that are actually going to get you to where you need to be. And I think that's the most important thing a lot of people need to understand, isn't it?
Well, I think this is a really good time to do that, Brett, because if you think about it, the market's still going to be strong for a while. And then we know, just like every other cycle, it's going to slow down. And you don't want to be stuck at the end of this cycle with the wrong assets. So I know one of the things that you and the team at Metropole do is actually have a look. Well, is this going to get you where you want to get to? And this asset that you own, that you bought, and that you probably put a lot of emotional attachment to, and maybe it's the right time to sell a lemon when there's lots of other buyers out there and replace it with something better.
It's a really good point. You know, it's that time of the market. And look, I think that's the biggest value add clients, Michael. It's not telling them where to invest or what to invest in. It's actually making sure that they've got the right assets on board or they're moving towards the right location, identifying the risks, particularly at the moment. You know, the market's not going to perform like this for the next 5 years. So really defining that and understanding that. And when you've got a really well-documented plan, you can minimize your mistakes and maximize your results.
That makes sense. So I guess there are 3 important parts of the investment equation. When you invest in property, I guess there's really only those 3 levers you can pull. Your budget, and that's determined by the banks usually, location, and you can't afford to compromise on that. And then, of course, the right property in that location. And unless you've got an unlimited budget, and that applies to very few of us, investors usually need to compromise on one of those 3 things. Budget, at the moment you just need it all, location, or maybe the type of property. So you'd maybe choose an apartment or a townhouse rather than a house in that location, Brett.
Yeah, look, we obviously agree a lot, Michael. We've been working together for more than a decade, so we've got similar thoughts on that. But I guess, you know, we always say that 80% of the location is the location that does the heavy lifting. So give me some more thoughts on your thoughts on that, Michael.
Sure. Well, it's very difficult to answer because, as I said a moment ago, it depends upon the investor. I don't know Russell's details. Thank you for leaving a question, but it's general. And yes, you said it's hypothetical. So it depends what you want out of your property. It's impossible to say a particular location is perfect for everybody. And if you've been following my blogs, my podcasts, my videos, you know, I believe that residential real estate is a high growth, relatively low yield investment. And that's why I'd only invest in locations that are likely to outperform the averages with regard to capital growth over the long term. But I do recognise that most investors need sufficient cash flow to service their debts. So yield's important. So that's also got to be taken into account when choosing a location. So I guess maybe the first thing when selecting a location, I'd initially start by eliminating a location. For example, I wouldn't invest in regional Australia. I wouldn't invest in the smaller capital cities. Now, no doubt there are some better performing regional locations or certain suburbs in some of the small capital cities that are going to outperform the poorer performing suburbs in our big three capital cities. But when I suggest you should invest in those big capital cities, I think it's really important still to actually select the right locations in those suburbs. So you really can't compare a regional town of, 100,000, 200,000 people to Brisbane or Sydney, which has got 2.5 million people, or Melbourne that's got 2.5 million people. There are markets within markets. But I know, Brett, rather than looking in the rear vision mirror, what we tend to do, we don't want to look, we want to know what's happened, but we really look for leading indicators of what's likely to happen in the future. So we look for locations where there's going to be strong growth, with strong economic growth, jobs growth, which is going to lead to wages growth and population growth. But more than that, I know our research team looks at the demographics. We look for affluent demographics. People are going to be able to and prepared to keep paying more, and particularly also where tenants are going to be able to pay more in the future.
That's a really key point, isn't it? Particularly looking, I know people like to invest in cheaper areas, but incomes and wages aren't growing that much. But getting back to what you said, Michael, I always say don't fight the majority trends, that you're a little bit more descriptive and like to say, why fight the big gorilla? But if we go back and look at the big trends and start with those bigger fundamentals, things like, supply and demand and growth, infrastructure, 80% of people who move to Australia move to predominantly Brisbane, Melbourne and Sydney. And Brisbane's slowly catching up, but it's mainly been, Melbourne and Sydney. So they're the ones that have the big economic growth, the huge employment hubs. And people are going to keep moving that. That trend's not going to change. In our inner to middle ring suburbs, there's just no more land available. So, on the outskirts, you can build another 1,000 houses and things like that. But we've got that permanent imbalance of supply and demand almost. And I think that's critical. I know a lot of investors I've seen that have made mistakes have probably felt, more emotionally attached to locations. And, they buy close to where they live or they're comfortable because they know a certain area or location. And they're really just emotional reasons rather than basing the decision, taking the emotion out, looking at facts and data and research. So I guess a good question to ask is how far are you willing to invest from home? Because, clearly...
That's a good question, Brett, because most people aren't, are they?
They're not.
They want to go past. People, how often do you hear people say, hey, I want to invest near where I live so I can go and do the repairs, or I can save some money on collecting this rents or doing other things like that?
Yeah, look, it is a safety thing, isn't it? You're almost playing the game not to lose, I guess. You want to be within your comfort zone and within your space and hopefully things work out. But like I said, if you're willing to open up and just allow the facts and the data and the numbers to tell the story, then, statistically you're going to be much more successful. I know there's about 3,800 statistically reliable suburbs nationally, but in my mind, very few of these make investment-grade suburbs. And one thing we do, Michael, if we're asking you to invest in a suburb for 20 or 30 years, we actually want to know what happened in the last 20 or 30 years. History's not a tell-all, but it's a really good indication of what's been happening. And I guess if we're buying in suburbs that have only been around for 5 years, there's not that track record of growth. And also what happens in a GFC in a downturn? Is a suburb going to lose 5 or 10% and recover, or are we losing 30 or 40% and waiting 5 or 6 years?
Sure. So that's actually very different to what many people are doing and what many of the articles and the podcasts are about, finding the next hotspot or the next big thing, which I guess many beginning investors chase. But as you dig deeper into the data, you're going to find that not all land's created equal. Some suburbs, as you say, are more popular than others and have always been, and they're going to, because of their scarcity, remain more popular. And over time, some land increases more than others. Doing research on all the suburbs around Australia, we found that some outperform others by up to 100%. And a lot of it has to do with the demographics there. And again, it's not a judge of people, but it really has to do with the wealth of the people there, the number of owner-occupiers there, and their wages. Now, I know, Brett, in the past you've spoken a bit about one of the things people don't even think about or look at, and is the percentage of owner-occupiers. They tend to think about who the tenant is going to be or where the nearest railway line is, but not the biggest driver. People who buy 70% of properties in the area.
It's interesting, isn't it? I always like to say that investors buy with their calculator. Homeowners get emotional. They pay too much. They overcapitalise. And you want to be in that kind of an environment where, in the market.
So you're right. So when we look at suburbs and when we break them down, we've broken them down into 4 different types of suburbs. Now, if you've been listening to this podcast, you've heard this before. Please don't turn off, because I think it's really important, because while most people are going to most investors look for what they call affordable suburbs, because that's what other people teach you to do: buy around the median, buy below the median. That's not what wealthy investors do. That's not what wealthy owner-occupiers do. And as Brett just said, owner-occupiers drive the markets. So first of all, sort of suburbs that are around are discretionary locations. The most expensive suburbs now, capital cities, the established money locations where the residents have lived for a long time and where many residents have paid off their home loans. Now, if you think about it, if interest rates rise, well, look, we know they're going to, and they may not rise as much as some of the property pessimists predict, but they will slow things down a little bit. These areas won't be hurt because people don't have much of a mortgage against their houses or any mortgage at all. So over the long term, these discretionary suburbs, they tend to outperform the averages. So I think if you can't afford those, just go to the next suburbs, the ripple effect, where you're going to find aspirational locations, which tend to be the upper middle class areas and particularly gentrifying locations. Again, the demographics, so the young millennials often moving in, they're affluent people aspiring to start their families and buy houses and do them up and improve them. And you're going to see that in all the capital cities. And as you wander through the suburbs, but you see the changing neighbourhood. Boy, has that happened in a lot of suburbs in Brisbane as you drive through. They're so different to a decade ago.
Yeah, look, I can have a flashback to my days on the road as a buyer's agent, Michael. I used to get really excited if I'd go down a street and I'd see one house being knocked over. There's a concrete truck backing into another one. There's a development happening up the road. You know, you can really see the gentrification, the older retirees and lower socioeconomic moving out of the area. And as you said, the young millennials and family formation and high incomes moving in and really changing the area.
Sure, but you've got to be careful who's changing and what, because you don't want to be right where all those new big apartment blocks are. Now, I actually don't mind the big apartment blocks being built above the shops in the shopping centres because that makes the local shopping centres more vibrant. Neighbourhoods very important, but I don't want to be near them but not too close to them. I know in Brisbane there's been a lot of rezoning and you've got to be careful what's going to happen in your backyard.
Great point, Michael. You know, you don't want to wake up one day and have 100 apartments or 1,000 apartments sitting behind you. So that's very, very critical and a lot of the zoning checks we take out as well.
Sure. So as we're talking about the sort of locations boy, this is a long answer to Russell's question, isn't it? But I hope it's useful as you and I this is what we think as we formulate plans for clients. So we like the aspirational suburbs, we like the discretionary, more affluent suburbs, and we avoid the affordable suburbs. So we like those areas where people are prepared to pay a premium to live there, but the affordable suburbs, and then there's that other last group of suburbs, which are those suburbs that people live in because they got no choice. That no one wakes up in the morning saying, I want to live there, but they end up living there, unfortunately, because that's all they can afford to buy or afford to rent. So I avoid those. And moving forward, they're the areas where wages won't have grown as much, but property prices have grown everywhere, even in the C and D suburbs last year, and so they're going to be unaffordable to the people living there. But of course, it's not just location that's important. There's also important to get the right type of property. And I know at Metropole, as you look after the buyers agents, they try and class properties into one of three distinct categories.
Yeah, that's right, Michael. And not every property in the right area is the right type of property as well. So, you know, we're looking for A-grade homes, investment-grade properties, that the types of assets you want to own and the type of property where tenants want to live, not because they need to, but because they want to and are prepared to pay extra to live in that particular property. They're not just houses, but also family-friendly apartments in great neighbourhoods. You shouldn't rule those types of properties out because the location's the most important thing. The B-grade properties still have a lot going for them, and during the hot markets like we're currently experiencing, they do outperform. But their secondary locations within that suburb or less than perfect properties mean they kind of slump in downtimes. And think of the main roads or the train line kind of properties. You know, we kind of steer away from them. The last one's the C-grade properties, and these are the ones we avoid at all costs in busy neighbourhoods. They might be in a good neighbourhood, but you want to demolish the property and replace it with something more appropriate. And there's nothing wrong with that.
Like what you bought me in Camp Hill last year. Boy, was that a C-grade.
I don't believe we got away with that one. But it was a location, wasn't it?
Well, it was. In fact, it was untenantable. So, boy, was that a C-grade property. But therefore, the location did well. And the intention was to pull it down and build 2 townhouses. So you're right. It's not just any property in the location that you look for?
Yeah, look, I guess building upon that, maybe just discussing some of the factors our buyers agents look at, when they're selecting an investment grade property. And I'm a big believer in, as you are, in buying below intrinsic value. And intrinsic value is its replacement cost. So, we're not buying off the plan. We're not paying a premium and developers' margins and kickbacks. We're looking for something with a strong land component. And we like to measure the land to asset ratio. It's easy to look at with a home and things as well with a house, but apartments, it's important to understand apartments and townhouses also have a land to asset ratio. And, clearly if you're buying something with 300 apartments in the complex, the land to asset ratio is going to be quite small. But if you're buying in those nice family friendly, small boutique apartments, you can really, do quite well with that land component. The other thing we like to talk about, Michael, is having something where there's a bit of an X factor and something a little bit different about the property. So, if we are buying an apartment, maybe it's got an extra off-street parking, a large courtyard or something like that that's quite special. And then, again, one thing I think that, gives property the edge over other investments is the ability to add value. So hopefully somewhere, maybe you could do a simple, small cosmetic renovation or, all the way through to a development like we're doing for you, Michael.
Sure.
I know we've been going on a bit, Michael, as you said, so maybe we get back right on to poor old Russell's question and working out, what are your thoughts on how to invest that $1 million in around the country?
Yeah, we have gone on a bit, so we'll probably only be able to get one more question in the show. But, okay, where would you invest? If it was in Sydney, where the median value is close to $1 million or over $1 million anyway, it'd be hard to invest in a investment-grade house, in the great location in Sydney, but the budget would definitely secure a family-friendly apartment in one of Sydney's high-growth suburbs. Now, the gap between Sydney's apartments and houses has never been as wide as this for a long, long, long time. And so I believe in Sydney's inner and middle ring suburbs, apartment prices, which are about a quarter the price of houses in the same neighbourhood, actually make up a great potential investment. But again, family-friendly, low-rise, medium-density apartments in Sydney's inner suburbs, inner west, lower north shore, and they should be, I guess, in a small boutique block. I think, 10, 12 apartments rather than the huge big box apartments with hundreds. Okay, Melbourne. Well, look, like Sydney, $1 million isn't going to buy you a house in a great Melbourne suburb, except it would buy you a good townhouse in the southeastern suburbs, ones that would make a good long-term investment, or villa units. I like those as well. Townhouses are really in strong demand in Melbourne with owner-occupiers and definitely with tenants, and make up a large part of my portfolio. I also have villa units, and I know you do as well in Melbourne, Brett. So Melbourne's middle ring and inner Bayside suburbs, I like Cheltenham, I like Parkdale, I like Mentone, where you'll get a great property, Mordialloc, for $1 million. And you can still get a single-storey older villa unit with renovation potential that you talked about a moment ago, doing up in Elsternwick, Caulfield, Glenhuntly or Surrey Hills. Now, Brisbane, Brett, I'm not going to make a recommendation here. I'm going to let you, since you're the Brisbane expert. Clearly, it's been the top-performing market for the last year and is going to continue for this year. But $1 million is still going to get you a lot, isn't it?
It certainly is. I think, as most people are predicting, I think we've still probably got another 12 months of growth, and it's not going to be the extreme growth we've seen. But there's certainly huge demand for housing at the moment. We're getting a record number of migrants moving up this way. I know there's, as I said before, I sit next to our property manager, and every second or third person is either from Victoria or New South Wales. So, that trend's rapidly increasing. But look, $1 million would be a good home in an inner Brisbane suburb, and some of the areas I would consider for a home, in that inner to middle ring area. You're kind of looking in areas from Holland Park and Cannon Hill, where we kind of bought for you, Michael, on the south side.
I'm glad you included that suburb you bought for me in your list.
I might be in trouble if I didn't, hey. If we're moving north, Stafford and Wavell Heights and Kedron and places like that. Out west, we're looking, Chelmer and Graceville. There's a small little couple of pockets out there. We can also look at those types of areas where we're looking for something in those areas, Michael, we're looking for probably a land to asset ratio of 70 to 80%. Really, really good, strong land value, a modest home that's going to get you through the years and, really continue to increase in value.
Fantastic. So, Russell, thanks for leaving your question. And again, rather than asking where should you invest, the question you should be asking is, what do I want to achieve from my portfolio? What do I need to get those results? And I guess more importantly, who do I need on my team to help achieve the financial freedom I want with minimal risk? Now, Brett, there's another question I want to actually ask you, which follows on from what we just discussed about Brisbane and what the floods are going to mean. And I bet you get a lot of questions about that too. But before I do ask you that, because I'm really interested, I know you've done a bit of research on this, I think it's worth just pointing out to those listening to this that if they want to take advantage of our property markets moving forward, it's not going to be as easy as last year. Everyone looked smart last year. You could buy a property, go away on holidays, come back, and you were 20% wealthier. It's not going to work that way this year. But I hope that by listening to our discussion, you're going to be able to understand that at Metropole, we have a framework, we have a strategy to help our clients outperform the averages. And it all starts by putting a plan together and then by using our research department to dig deep into all the suburbs around Australia, and then our on-the-ground buyers agents to within those suburbs find the right properties. And we've got the backup of our wealth advisory, financial planning, property management, renovations, development, and even our business advisory divisions. So if you want to outperform the averages, if you want to grow your wealth and minimize your risks in this time where the market's changing a bit, why not go to metropole.com.au, find out about our range of services, leave your details and see if we can help. Now, Brett, I know that you're still happy to have a chat. You still, even though you're a national director and manage a number of divisions of the business, you still see clients, don't you?
Yeah, look, I really enjoy it, Michael. It's great to kind of help people out and help them, give them direction, some clarity and certainty moving forward in sometimes a difficult time.
Sure. Well, Brett, now we're only going to have time for one more question, but this came from Judith, and as I said a moment ago, it's the sort of question that I bet people are asking you because I know they're asking me. And to put it really simply, the question was, what will the recent floods mean to the Brisbane property market? They're only meant to happen once every 100 years, she says, but they've happened a decade ago and again now.
Yeah, look, it certainly caught us by surprise, all those Brisbaneites, but it's unfortunate that it happened. And, for people who are still struggling, it's important we help them out as well. But I guess most investors will turn to the property space and want to understand what will happen there, like Judith has. And I guess the first place to start, Michael, is the economic environment. And I think at this point in time, when we compare it to 2011, the first huge notice.
Well, 2011 was the last time there were big floods, so I think that's a really good example to see what history teaches us.
That's right, yeah, the last floods of 2011. You may remember back then, Michael, the standard variable interest rate was actually north of 7.5%, would you believe? That's a huge difference to where we are today when considering you get something in the 2% these days. So that's the first noticeable difference. The other type of thing I like to look at are the drivers for property, and certainly the number of jobs created. If you remember back in 2011, we were just coming off the back of the GFC, and I think everybody was kind of in recovery mode. So things were starting to ramp up again, but we certainly didn't have the jobs being created, and there wasn't as much migration taking place and people moving up this way in those uncertain times. So they're two things that have turned around quite substantially. From late 2017, we've had about $16 billion of infrastructure spending, and that's created about 100,000 jobs in and throughout Brisbane alone. The Queen's Wharf project, the second runway at the airport, huge infrastructure projects that are bringing in workers, but also tier 1 and tier 2 jobs and professionals that may have gone elsewhere. And those jobs have sent, I guess the numbers skyrocketing, and we're at record interstate migration at the moment, the likes we haven't seen since probably the 90s. So that's quite extraordinary.
So I guess what you're doing is we're seeing what the context of these floods are, which is going to, in some ways, dictate how the results are going to turn out.
Yeah, so that's the first thing, understand the economic environment. The second thing is look at history. And it's not really going to tell us what's going to happen in the future, but I think it's a really good tool to analyse. And we've had a couple of, I guess people analyse what's happened since the 2011 floods. The first one was property economist Chris Eves from the Queensland University of Technology, and he found only a passing short-term effect on property prices, really. They declined in the first quarter, and then by the middle to end period of 12 months, they'd kind of rebounded back to where they were. So that was quite interesting to note.
Now, was this the same in flood-prone and non-flood-prone suburbs, Brett?
It was actually. He found that both suburbs, as I said, fell in that first quarter, but they steadily rose. And I think the second part of the equation, the second part of the research from Michael Matusik actually looked and broke down and segmented how the dry suburbs compared to the flooded suburbs. recovered. And what it showed was obviously clearly the dry suburbs had recovered quite quickly, much quicker than the flooded suburbs. But he also compared it to a median and what the market average was. And interestingly enough, Michael, after around 2 to 3 years, the flooded suburbs actually took over the market average. So,
they grew quicker?
Much quicker, yeah.
Was this a bit of a catch-up maybe, Brett?
They did, yeah. And it was a much, much different kind of market. So I think this time around, I actually don't think, I guess the drier suburbs, I don't see any changes. I know last weekend we had another record round of auction results. We had a record round of, prices rising and things like that. So I think it's only going to create more demand in those types of areas, those really dry locations, more elevated areas, more affluent areas that we always talk about.
I think it's also going to mean that some suburbs are, for a period of time, and especially this seemed a bit of a bigger event than my memory of 2011, they're going to be out of favour. But I know that they've always been out of favour with you and your team at Metropole.
Yeah, they are. I mean, look, it's one of the first things we do. It's 99% of the time we know where the flooding is going to occur. We've got flood maps, we've got reports. So, it has to be a part of your due diligence, especially as a homeowner or investor. And it's something that we instantly rule out. There's no second consideration given. And I think the other thing that'll help with investors, particularly, Michael, is the fact that Queensland's already having a rental crisis, and there's a number of headlines that are in the paper every day. But I think these type of events only really push more demand on those properties that are flood free or in higher elevated areas. So I guess getting back to Judith's question, the market did recover in a significantly less type of downturn economic environment, and now we're in a stronger environment. I think it'll just be a real short-term play.
Well, having said that, I think it's also worth mentioning that when you do your due diligence, it's not just flood water that you're looking at, it's also stormwater and overlays that don't occur as much in other states.
Yeah, great point. It's something that a lot of people miss out on. They automatically think, if we're out of the flood area, we're going to be okay. But there's obviously a lot of stormwater, and that's what happened in the past. It actually wasn't the flooding; it was the backing up of the stormwater and drains being blocked and things like that as well. So again, they're things that you can find out quite easily by printing reports and looking at council websites. But it's really important to understand the big picture with flooding and stormwater and those types of things as well.
I think one of the risk factors that investors forget about is climate risk. And this is one of them, that around Australia, more properties are going to be uninsurable or more expensive to insure. And it's not just the floods, it's also fire areas up north in far north Queensland, and there's issues about cyclones where it's really, really hard to get insurance. So even though they're good areas to live in, they're not where we choose to invest and we recommend investing, but I know some people do because of the higher yields. If you can't insure your property, or if the insurance costs so much it eats a huge chunk out of your income, I think that's another risk people have to take into account in the general property equation, Brett.
Yeah, look, it must be incredibly difficult if you're in a flood area or a fire area and something like that does occur, and losing sleep at night and things like that is not nice. But I guess coming back to what we spoke about before, Michael, just make sure you follow the big trends. There's safety in numbers, as they say.
Fantastic. So we only got through 2 questions, but I hope the detail that we put into both of those are going to help. First of all, Russell and Judith who sent us the questions, thank you, and to our listeners as well. And if you would like Brett and I to discuss your questions in our monthly question and answer show, just leave a comment on any of the articles in Property Update or our websites, and we'd look forward to having a chat with you. Brett, thank you very much. Catch up with you again real soon.
Thanks, Michael. That was a great session.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's Mindset Moment, I'd like to share a message I learned from one of my mentors, Jim Rohn, who explained, if you can change yourself, you can change your life. What Jim Rohn said is life is about constant, predictable patterns of change, and the only constant factor will be our feelings and our attitudes towards life. He said, we as human beings have the power of attitude, and that attitude determines choices, and the choices determine our results. All that we are and all that we can become has indeed been left up to us to decide and interpret through our attitudes and our choices. Jim Rohn said, life is like the changing seasons. You can't change the seasons, but you can change yourself. So the first major lesson in life is to learn how to handle the winters. They come regularly right after autumn. Some are long, some are short. Some are difficult, some are easy. But they always come right after autumn. And that's never going to change. Jim Rohn said, there are all kinds of winters. The winter when you can't figure it out. The winter when everything goes awry. There are economic winters, social winters, and personal winters. Winter times can bring disappointment, and disappointment is common to all of us. So you must learn how to handle winters. You must learn how to handle difficulty, because it always comes after opportunity. That's never going to change. The big question is what to do about winters. Jim Rohn said you can't read January simply by tearing it off the calendar. Of course, he was talking about the American winters there. So he said you can't just tear it out of the calendar, but here's what you can do. You can get stronger. You can get wiser. You can get better. Remember that trio of words. Stronger, wiser, better. The winters won't change, but you can. Before I understood this, I used to wish that it was summer when it was winter. When things were difficult, I wished they were easy. I didn't know any better. But then my mentor gave me the answer as part of his unique philosophy when he said, don't wish it were easier. Wish you were better. Don't wish for fewer problems. Wish for more skills. Don't wish for less challenge. Wish for more wisdom. So the bottom line is, if you can change yourself, you can change your life. I hope you enjoyed this month's question and answer show with Brett. We didn't get through many questions, did we? We only got through 2 because of the long answers. But if you'd like us to answer your property, money or success related question, just leave it on any of the blogs on Property Update. I read all the questions, answer many of them online, and would be happy to discuss those with you in a future show. But by the way, if you got some benefit from today's question and answers, please tell somebody else who you think would also benefit. Help me in my quest to make as many people financially fluent as possible. Of course, you can catch me in between these twice weekly shows on social media. Just go to Facebook and look for the Property Update private Facebook group. But I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?